Good morning. Welcome to Stock Market Today for Friday, February 26th, 2021. This is your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I'm at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider. It hits your inbox every trading day before the market opens. So the sell-off resumed yesterday with growth and momentum factors under the most pressure. Tech, discretionary, and communication services underperformed. Utilities, healthcare, and staples outperformed, but all sectors were lower on the day. Treasuries rose sharply, the yields, that is. Prices obviously lower as they move inversely. The dollar was stronger against the yen, but flat on the euro cross. Gold finished down 1.3%. WTI crude finished up 50 basis points. And the big story this week is that sell-off in treasuries / spike in yields. And as we get to the desk this morning, futures are down for the S&P about 20 basis points after Asian markets came under some heavy pressure overnight. Japan down nearly 4%. Hong Kong was off about 3.5%, and China was down 2%. European markets are mostly weaker as well. Treasuries are stronger after yesterday's sell-off, with the 10-year back below 1.5%. The dollar is stronger on the major crosses. Gold is off 1%. WTI crude is down 1.2% to kick us off on a Friday that starts off with, I guess we have something different to say. For the SPY, we don't really. We're testing the top end of support at the 370 to 380 range, 340 the key level below that. In between, chop. But thus far, holding. That's important. The Qs has been, I don't want to say ground zero because it's more than that, but the types of names that have been under pressure over the past couple of weeks are the high multiple growth stocks. A lot of those do reside inside the Qs, and a lot don't. A lot are just too small to be in the NASDAQ 100. But the lower end of the range has been tested now, 315 to 320 near-term support. We are still above 300, so we're in that kind of key area between 300 and 320 that is going to be important for keeping the structure of the uptrend off of the March lows intact for the Qs. We're going to watch that closely. Now, what I will note is that treasuries have reached a key support level. Look at IEF. Take your chart out 5 years. And what you'll see is that it tested a level that we saw in March, which lines up with the peaks from 2019 and 2016. So if treasuries are going to bounce, they are likely to do so from here. And if they do, I think that would alleviate some of the pressure on the growth theme. Small caps holding up the best thus far. IWM still above support in the 200 to 210 zone, then 160, 170 below that. So for SPY, the structure remains the place. The trend is still up until proven otherwise, but in some instances, they are doing their best to prove otherwise. But thus far, risk management, if you have a process in place, it might be triggering some of your levels. That's forcing you to raise cash, which then puts you in a position, should things stabilize, to begin to redeploy that cash. Now, let's talk about our market in a minute. Let's hit our key points in our note today. The sell-off resumes centered on the high multiple growth stocks. That's what we've been talking about. Everybody's been talking about for the past few days. The growth versus value ratio has broken near-term support, so we'll look at that chart. High beta versus low volatility is extended to the upside, and we'll talk about why I think this is important, because it is a proxy for the cyclical recovery trade, as is the copper-gold ratio, which is overbought and now at resistance. Futures point, as I said, to a lower open here today. Now, taking a look at the major indices from a power bar perspective, as well as yesterday's performance, and we can't sugarcoat this. Yesterday was ugly. The Dow was the best of the bunch, down 1.74%, 8 to 5 bulls to bears there. S&P down 2.4%, 135 to 54 bulls to bears. Nas underperformer, 19 to 21. So the ratio flipped here yesterday on that weakness. Small caps down the most, 755 to 194. So some profit taking, obviously, in the small caps. Bonds, again, down hard, down 1.63%. Spike in yields. At one point yesterday, the 10-year was over 1.6%. Now, we are backing off a little bit this morning. As I said, according to the Chaikin Power Bar, small cap stocks and large cap stocks are bullish. Taking a look at our stock of the day now. If rates are going to stabilize and the Qs are going to find support, A Texan is at an interesting level or getting close to an interesting level. That's Texas Instruments with a bullish rating, strong trend, strong industry group, trading down to the rising long-term trend line, which since being broken back in June has been support and, at or near oversold levels on this trend line have set up interesting opportunities. What's good about this is you kind of have your key levels that you can manage risk against. But if we are going to get some stabilization in rates and we're going to get some stabilization in the Qs, I think that a stock like Texan starts to look somewhat interesting within the context of this uptrend, especially if it pushes lower or the ratio, the overbought oversold indicator pushes lower. Let's take a look at our sector tracker now. Looking at the movement in the major sectors over the last 5 days of trading, it still continues to point to the cyclical recovery trade. Look at the energy, financials, industrials, materials. REITs jump in now, and something I probably should spend some time digging in on because we're seeing some pop in REITs here of late. Maybe it's a function of investors searching for yield. I don't know. We'll search it out. In the middle of the road, healthcare staples, comms, and then laggards, tech, in utilities and discretionary. And again, I think it's largely a function of mega cap tech, right? Mega cap tech is, or mega cap names. Mega cap tech, obviously Apple's been under pressure. Take a look at that. Take a look at names like Adobe and some of the other big software names. In discretionary, right? We're talking about cap weighted sectors. Well, the two biggest weights in discretionary currently are Amazon, which has been an underperformer and under pressure, as well as Tesla. Same story there. So something to keep in mind. Taking a look now at our industry in focus, transportation services. And this is fascinating to me, right? And it really paints the picture of what's happening in the marketplace because over the past 6 months, it's outperformed by 24%. Power bar ratio, which measures future potential, is strong, 13-5 bulls to bears. Middle of the road, number 11 of 21 subsectors, moving up 3 slots over the past week of trading. But some of the indicative names there, ArcBest, ARCB, Ryder, letter R, and Hub Group, HUBG, all three with very bullish ratings, all three holdings of the Transport Fund, XTN, which does have a neutral rating, but is a solid outperformer. So let's think about what that means from a market perspective. If we thought there was really something nefarious going on in the markets, something to be really overly concerned about, I think you'd see transports under pressure. And I don't think you are. I think what's happening in the market is kind of investors waking up to what we've been talking about for months, which has been taking a more balanced approach to equity allocation. Right, the set it and forget it, own growth and nothing but growth trade is coming off, and it's been coming off since September. The spike in rates has accelerated the move here. It's rotation within the marketplace. It's a broadening out of participation to the upside. So transports in the near term, rounding out of an overbought condition, but still an outperformer. You can say, well, look, we're extended above the long-term trend line. We're outside of the upper volatility band. So maybe a little pause here. And I think that one of the things that we can say is the cyclical recovery trade is extended to the upside. So think about what's playing out here. Treasuries have spiked lower, yields have spiked higher, yields into resistance, treasuries into support. The growth theme, right, has been under pressure. If we do see some stabilization in treasuries, I think maybe we could see some profit taking in the cyclical recovery trade in the near term. It's not to say the trend is over. It's to say maybe it's a little ahead of itself in the near term, and people might want to take some money off the table within those themes. It's something that I am writing about today in my note and thinking about a lot. Let's take a look at what's moving now. Yesterday's gainers and losers are movers and shakers. FTI up 12% following their earnings announcement. PWR, Quanta, up 4.3% on their print. Twitter, Analyst Day, where they put out some new goals. Market liked what they heard there, up 3.7%. SBAC up 2.4% following C-band auction results that took a lot of the tower companies higher yesterday. CME caught an upgrade at Wells Fargo, which was enough to pop that stock 2% in a down tape. I mean, you think about 2% in a tape where, the S&P was down as hard as it was. That's some pretty significant outperformance on an upgrade. Taking a look at the loser side of the board, mostly earnings related. NetApp or NTAP, whatever you want to call it, down 14.5% following their print. Ansys certainly falls into that grow, mo group, and their earnings print took 12% out of the stock yesterday. BBY down 9.25% on their earnings. Lam, no news there, but down 8.25%. And NVIDIA down 8.2%. And that is largely a function of their earnings announcement. And a lot of people were baffled by this reaction to the stock. Now, number one, the numbers were phenomenal. But some people are pointing to a potential deceleration in their data center biz and didn't like that aspect of the report. So took 8% out of the stock yesterday. Let's dive into the charts. Obviously, the one that's on everybody's mind from a factor standpoint, the growth versus value trade. Now, I've shown this chart in my notes. I've shown it here numerous times, and it's been nowhere since September. Okay, so the fact that we're breaking down now, it's okay, it's important, but the simple fact of the matter is, we've been saying for a while, a more balanced approach, a more balanced approach, a more balanced approach. I mean, this is not a new phenomena. Right? It's just a continuation, really. Interesting to me that the ratio has become oversold for the first time since 2019. And as that plays out, we're watching this consolidation between the Qs and SPY as well. So want to be really mindful of what's going on here. But again, if rates bounce, you'd expect to see this recover. And if rates don't bounce from here, then this is a broken trend and likely continues to the downside. So we're at some key levels. I think there's a lot of work to do this weekend. High beta versus low volatility. And this was a standout to me in my note today. This ratio is now sporting a 200-period Z-score of over 2.5. It's actually a 2.6, right? So if we think about that, it's 2.6 standard deviations above its 200-day average. It's up near peaks over the past 5 years that have tended to mark a reversal in this ratio. Now, this ratio is a proxy for the cyclical rotation trade. High beta is full of energy and financials and those pockets of the market that have been strong on better economic prospects. At the same time, this ratio has been strong. Right here's September. Look at the spike as that growth value trade has come off as well. So again, interesting that we're this extended with the treasuries at a key support level, with the Qs at a key support level. We're going to learn a lot over the next couple of days as it relates to trends. Risk management is going to become important if these trends continue. If treasuries don't hold and you own growth stocks, I'd expect to see your stops get hit. Up, extended, overbought. Take a look at the RSI of this ratio. Extended from the 200 days, certainly. RSI in an overbought condition. So could we argue for a pause on the cyclical rotation trade? I think we could. I definitely think we could. Take a look at this one. Copper to gold, also part of that cyclical rotation trade on prospects for better economic growth. Massive move to the upside. Now back into this congestion zone. And I get it. It's a wide zone, yes, but these are those highs from back in 18 where global economy started to slow down. We've spiked back. All right. Logical spot to take a rest? Probably. Pretty extended? Yes. At the same time, you can see that it's dragged rates higher, right? All part of the same trade here. And now the 10-year is trading into former support, now potential resistance. Logical spot to pause. Logical spot for the treasuries to bounce. I think you can make that case, right? And if that doesn't play out, well, then we have a ton of information that can walk us through the upcoming weeks and months. So that's what I'm focused on today, and that's what I'll be spending a ton of time on this weekend. So that'll wrap us up. Head over to chaikinanalytics.com/test drive. Sign up for the free 14-day trial. Have a great weekend. I'll be back with you on Monday.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.